All right, so we will get started with our behavioral finance lecture now. Now that we have completed our discussion on market efficiency, we are now going to turn our attention to looking at investor behavioral biases and how they can potentially impact the prices of securities, right? So this is a relatively new field, a very popular area in finance now. It has gained a lot of ground since the dot-com bubble. And what this field is essentially a blend of psychology and finance. So, a lot of what we talk about in this particular discussion borrows heavily from psychology. Some of the examples that we use are from psychology area, experiments in psychology, and so on. But for most part, we will try to take that experimental evidence from psychology and see how it can be applied to understanding investor behavior and its implications for security prices. So, I'm going to start with some anecdotal evidence of irrational investor behavior. All right, one common type of irrational behavior that we see from time to time is ticker symbol confusion. Like this example here from a study that is very cleverly titled Massively Confused Investors Making Conspicuously Ignorant Choices, MCI MCIC. This is an example of ticker symbol confusion. MCI Communications had a ticker symbol of MCIC. It was in merger negotiations with another company, and a completely unrelated company, which was actually a closed-end fund with ticker symbol of MCI, was actually responding to any news that came out about MCIC. So investors were basically confusing MCI for MCIC. If you recall, I mentioned in class the example of Zoom video communications. Zoom that is a very popular meeting software. Many of the professors are now using it when they're teaching remotely. So Zoom has been in news a lot as more and more people are working from home, and Zoom has ticker symbol of ZM, and another company which is basically non-operational, a defunct company called Zoom Technologies with ticker symbol ZOOM, actually has been going up for past several days in response to uh, the news about the other Zoom, which is the Zoom video communications, right? So another case of ticker symbol confusion. So we see this type of ticker symbol confusion from time to time, clearly an example of irrational investor behavior. Uh, Another example, so this is again, you can see here the company called AppNet Systems during the dot-com bubble period in 1999. It filed for IPO, and its ticker symbol was APPN. And another company, which was basically a bankrupt company with similar ticker symbol, was actually responding to this IPO filing of AppNet Systems. And in response, actually, this other company went up by huge percentage numbers in a couple of days. It had millions of shares being traded on the market. Again, this was basically a bankrupt company, pretty much a dormant company, and still it was responding to the IPO filing of this other company with similar ticker symbol. Um, so again, example of ticker symbol confusion. And then during the dot-com bubble period, we see another example of companies taking advantage of investor euphoria surrounding the dot coms, right? So investors basically were attracted to the dot com names. So what many companies did were they decided to change their names to become a dot com. They added a dot com to their name, so they were not necessarily in the internet or technology business, but they just put a dot com, did not change their business model at all. It was the same company. This was a purely cosmetic name change, but at least for a period of time, they actually benefited from this name change. Like you can see here, the example, the sample of 95 firms that changed their name to become a dot com actually earned a return of 74% in 10 days after the name change, right? Another example of irrational investor behavior. So we see many examples of this type, clearly suggesting that people do not always act in a rational manner. But what we want to actually look at this a bit more systematically, and specifically our focus is going to be on trying to understand if there is a behavioral based explanation for those various return patterns that we learned about in our market efficiency discussion, like momentum and post earnings drift and 52-week high effect and so on. Are there any explanations rooted in behavioral finance? We'll come to that, but as I was saying before, this field of behavioral finance, it's basically a blend of psychology and finance. It has gained a lot of ground during the since the dot-com bubble period, uh, because subsequent to the dot-com bubble period, more and more people actually subscribe to this view that investors might be acting in an irrational manner from time to time. Okay, so uh, there are two parts here that we are going to discuss. We are going to talk about behavioral biases, and we are going to talk about a critique to behavioral finance as to why smart investors don't take advantage of mispricing created by irrational investors. So, first part here is looking at information processing errors that are due to behavioral biases. So again, remember, the whole idea of market efficiency is that information is quickly and accurately reflected in prices in an efficient market. If, however, investors are prone to behavioral biases, they might not process the information correctly, and if that happens in a systematic manner, that might lead to mispricing, right? So we are going to talk about various types of biases that can lead to information processing mistakes. Okay. All right. So forecasting errors. So basically, investing is all about forecasting, and if investors make mistakes in how they develop their forecast due to their behavioral biases, then obviously that can lead to mispricing. So one of the common forecasting errors is what we refer to as a recency bias. A recency bias meaning putting too much weight on recent information or recent experience, and not adequately accounting for information that is somewhat distant. Like, for example, if a firm has a good streak of recent earnings performance, investors tend to believe that that good performance in earnings is going to continue in future. They tend to extrapolate from recent past information, believing that that trend would continue in future, which may or may not be right. So there is also this extrapolation of historical trends, what you observe in the historical data, the patterns in historical data, they are expected to continue in future, right? So that's basically forecasting errors, right? So this type of behavior can explain the continuation of performance. That is essentially what momentum is. If you recall from our market efficiency discussion. It can also explain earnings momentum or post earnings announcement drift. All right, so forecasting errors. All right, then we have overconfidence, one of the most pervasive behavioral biases, extremely well documented. Overconfidence, uh, basically, there is a lot of evidence to suggest that people tend to be overconfident. For example, there are experiments in which people are asked to rate their driving skills, and a majority of people, like in this experiment in Sweden, 90% of the people said that they are above average or above median drivers, right? So, median basically means that obviously 50% would be above median and 50% below median, right? So people sort of are overconfident in their driving skills. Similarly, in a more finance related context, when people are asked to estimate where the market would be in, say, 1 year, right? Provide a range for Dow Jones in 1 year time, that range tends to be too narrow. People do not adequately take account for the volatility of the stock market. They are more confident in their estimates of future stock market levels, right? So another example of overconfidence. And then what is interesting about overconfidence is that even very skilled individuals are prone to overconfidence. And in fact, there are certain situations where uh, overconfidence is heightened amongst skilled individuals, like when there is not a whole lot of hard information or hard data to go by, and there is a lot of subjective judgment that is required, right? There is a lot of uncertainty in those situations. Overconfidence is heightened. So there have been experiments done on neurosurgeons, for example, and other skilled individuals demonstrating overconfidence in uncertain situations requiring subjective judgment. So what that means is that even highly skilled market participants, like financial analysts or professional traders or mutual fund or hedge fund managers, they might even be subject to overconfidence. So it's not just individual investors, but even uh, highly sophisticated investors who might display overconfidence. Okay, so some applications of overconfidence. One is prevalence of active management. So this has been a big puzzle for many years. Uh, we learned previously that most of the actively managed funds actually do not do very well. They are not able to beat the passive benchmarks. They are not able to outperform the market, and yet investors keep putting their money in this actively managed funds and keep paying higher fees. So that is a puzzle. Why do people keep choosing this actively managed funds? And one potential explanation is that perhaps people are overconfident in their ability to identify good funds, right? So we know 80% of the funds don't do well in any given year, but we also then know that 20% of the funds do well. And if the investors believe that they can identify this other 20% funds and invest in them, they will be able to beat the market. So overconfidence in their ability to identify superior funds, that would explain why this actively managed funds continue to uh, survive. Okay, and then there is a series of papers by researchers at UC Berkeley and UC Davis looking at the trading behavior of individual investors, right? So there is a lot of data on mutual funds and hedge funds, but there isn't a whole lot of data on individual investors. So these researchers were able to get some data on individual investor trading, and what they found is that people who trade excessively, uh, they are overconfident and they subsequently actually have poor returns, right? So excessive trading, you can think of that as driven by overconfidence. People are overconfident in their ability to identify good stock investments or good investments in other securities. But it turns out that in this situation, overconfidence is detrimental to investment performance. These investors are not able to actually achieve superior returns. And related to this overconfidence is this so-called self-attribution bias, and this can actually explain why investors might become overconfident. Self-attribution bias is the tendency to attribute success to skill and failure to bad luck. So the idea here is that if you repeatedly think of your good performing stocks as due to your skill, and if you repeatedly think of your bad performing stocks as just due to bad luck or poor timing, then overall that would actually make you overconfident in your stock picking skills. Like, so if you have 10 stocks and 5 do well and 5 perform poorly, for the five that do well, you tend to think that those have done well because you have the skill to pick the right stocks. And the five that perform poorly, you tend to basically come up with some excuse like bad luck or poor timing or one time bad timing and so on. Right? So repeatedly, if you engage in this self-attribution bias, you become overconfident in your investing skills. Right? So that's the potential source of overconfidence, right? So overconfidence is a very pervasive bias, and it can be pretty detrimental to your investment performance. All right, then let's look at conservatism bias. So conservatism is basically the failure to update beliefs. Sometimes it has been found in experimentation that people are too anchored to their beliefs. They have these preconceived ideas, these notions about how things work, and even if there is information that contradicts that belief, they are reluctant to update their beliefs. They are just too tied to their ideas, and they are unwilling to actually uh, adapt to new information. And this failure to uh, respond to new information would lead to underreaction to new information, right? If investors have new information that contradicts their preconceived notions, they're not going to respond to this new information adequately. So there is underreaction to information, and underreaction to information can lead to patterns like momentum or post earnings announcement drift and so on, right? So this is what we refer to as conservatism bias, failure to update beliefs or being too tied to your original preconceived notions, even if there is new information that suggests that those beliefs are or those ideas are no longer valid. All right, so today we looked at forecasting errors, we talked about overconfidence, and we looked at conservatism bias. There are a few other behavioral biases that I want to talk about, but we will continue with this discussion in our next lecture. All right, so we'll continue with this behavioral finance discussion next time.